Have you ever looked at the stock market lately and just thought, is this for real? I mean, are prices getting just a little disconnected from reality? Well, you're not alone. It's a feeling a lot of people are having right now. And it really begs the question, are we on the verge of a massive crash? And could a ghost from economic history actually hold the key to what happens next?
So, what is going on right now? There's this nervous energy in the air, right? A kind of deja vu that has some of the sharpest financial minds in the world on high alert. All right, let's just ask the question head on. Is this whole party about to come to a screeching halt? Are we standing on the edge of a financial cliff? Because, this anxiety isn't just bubbling up from internet forums, it's coming from the very top.
Look, it's one thing to hear wild speculation online. But when institutions like the Bank of England and the International Monetary Fund start using words like overheated, well, that's when you really got to sit up and pay attention. And they are pointing their fingers directly at the AI boom. So for this breakdown, we're going to put two key pressure points under the microscope. First, that red-hot AI stock market, and second, the slow-motion crisis that's been unfolding in China's property sector. The big question is, are these two totally separate stories, or are they actually symptoms of the same, much bigger problem? To really get a handle on the risks we're facing today, we have to wind the clock back. We're going to Japan in the late 1980s, a time and place that gave birth to what many people consider the single biggest asset bubble in modern history. You see, the story of Japan's incredible rise and its spectacular fall, it's not just some boring history lesson. It's a playbook. It shows us exactly how market euphoria can spiral completely out of control and the devastating consequences that follow. And honestly, the parallels to today are, well, they're a little unsettling. To get a sense of just how massive this was, think about this number. At its peak in 1989, Japan's stock market made up 42% of the entire global stock market's value. Just let that sink in. Almost half of the world's equity wealth was tied up in this one country. And it wasn't just the stock market. Oh no, the real estate market was on a whole other planet. By 1990, all the land in Japan, a country that's 25 times smaller than the US, by the way, was valued at 4 times more than all the real estate in the entire United States. It's just mind-boggling. And if that last number didn't make your jaw drop, this one probably will. At the absolute peak of the frenzy, the tiny patch of land under the Emperor's Palace in Tokyo was valued higher than every single house, office building, and farm in the entire state of California. I mean, come on. That is the perfect example of prices becoming completely unhinged from reality. So what happened next? The aftermath was just devastating. After the bubble burst in 1990, it took Japan's main stock index, the Nikkei, 34 long years to finally crawl its way back to its 1989 peak. A whole generation of investors saw their wealth just evaporate. So how in the world does something like this even happen? Let's dissect the anatomy of a bubble piece by piece to really understand the forces at play. Because here's the thing, these same forces can pop up anytime, anywhere. At its core, an asset bubble is actually pretty simple. Think of it like a feedback loop. Rising prices get investors all excited, right? That excitement then pushes prices even higher, which creates this cycle of speculation that completely ignores what the asset is actually worth. Japan's bubble had a very specific 4-part recipe. It started with, step 1, easy credit, basically a flood of cheap money. That led directly to step 2, speculation, where everybody started piling into stocks and land. This created step 3, euphoria, this collective belief that prices could only ever go up. And finally, you have step 4, the trigger. The central bank raised interest rates, and just like that, the party was over. Now, it's really tempting to look back on this and just think, wow, everyone was so naive. But was that really the case? Did people truly believe there was zero risk? Well, surprisingly, no. Academic research from that time actually suggests investors did see real estate as a risky asset, even while prices were going through the roof. This kind of complicates that simple story of pure ignorance, doesn't it? It suggests people knew they were gambling, but they kept playing anyway. Maybe because they figured the government would just bail them out if things went south. Okay, so let's bring it all back to today. Using that 4-ingredient recipe we just broke down, let's see if we can find any of those same ingredients cooking in today's markets. First up, the AI boom. On the one hand, the argument for it being a bubble is pretty strong. We are definitely seeing ingredient number 3, euphoria. Market concentration is high and some key valuation metrics are flashing red. The Shiller P ratio, for example, is in the danger zone. But, on the other hand, there's a huge difference this time around. Today's AI leaders are incredibly profitable companies with mountains of cash, not just speculative startups running on fumes and cheap debt. Okay, now let's pivot over to China's property market. Here, it feels like the bubble may have already burst. Just look at this table. It shows the price changes from last year. And notice the trend. While the big Tier 1 cities are seeing, modest declines, the pain gets a lot worse as you move to the smaller Tier 2 and Tier 3 cities. Secondhand home prices there have fallen over 5%. And here's where it gets really interesting. Just like in Japan, the government is stepping in. Beijing is actively trying to manage the fallout from a bubble that was clearly built on ingredients 1 and 2, easy credit and rampant speculation. But this brings us to ingredient 4, the trigger. Where Japan's central bank pulled the trigger to pop the bubble, China is deploying massive support to do the exact opposite, to try and contain the crisis. So, after looking at the past and the present, what are the big takeaways here? How can we use all these lessons to think more clearly about navigating the hype and the risk in any market we find ourselves in? So, what has history taught us? Well, first off, diversification is absolutely key. Second, you have to beware the herd. That feeling of euphoria can be a huge warning sign. Third, and this is a big one, remember that recoveries can take a painfully long time, like those 34 years in Japan. Fourth, fundamentals always matter. Real profitability is a great defense against pure hype. And finally, never ever forget that government policy can change the entire game overnight. Which brings us to our final thought. You've probably heard the famous saying that history doesn't repeat itself, but it often rhymes. So as you look at the AI boom, the situation in China, and the broader global economy, listen closely. What rhythm do you hear? Is it the steady beat of real innovation and growth? Or is it that frantic, accelerating tempo of a bubble that's about to burst?